Hello everyone, and welcome to my financial analysis presentation on the Walt Disney Company versus Comcast Corporation. My name is Rob Stevens, an MBA candidate at Eastern Washington University, and I'll be taking you through the various criteria I used to decide which of these two companies to invest in. Before we get started, I'd like to give you a brief overview on the media and entertainment industry of which both Disney and Comcast belong. The industry is estimated to be worth $2.2 trillion by 2021, and when I say that Disney and Comcast belong to that industry, that's a massive understatement. They are by far the largest players in that industry, so much so that they might as well be that industry. These two companies have driven quite a bit of the consolidation in the industry, most recently battling over ownership of companies like Sky in the UK and 21st Century Fox in the United States. With that, let's take a closer look at the two companies, starting with Disney. Founded on October 16, 1923, the mission of the Walt Disney Company is to entertain, inform, and inspire people around the globe through the power of unparalleled storytelling, reflecting the iconic brands, creative minds, and innovative technologies that make it the world's premier entertainment company. Disney is best described as a global entertainment conglomerate and is comprised of four major business units: media networks like ABC and ESPN, its theme parks and travel experiences around the world, the films and TV shows it produces in the studio entertainment division, and its direct-to-consumer and international business. That's where the Disney Plus streaming network fits in, just in case you were curious. Disney is one of the world's most beloved brands, often in the top 5 most admired companies in the world, which makes it very interesting to compare to our other company in consideration, Comcast. Comcast started June 28, 1963, and prides itself on creating incredible technology and entertainment that connects millions of people to the moments and experiences that matter most. What started as a telecommunications behemoth, Comcast has built itself into an entertainment powerhouse with the acquisition of NBC Universal, which now makes up one of the 4 main business units within Comcast. The others are the cable communications business, which also includes wireless and voice, Sky out of the UK, and its corporate operations. Unlike Disney, Comcast is hardly beloved. Don't get me wrong, theme park enthusiasts like myself love Universal Studios and the film and television properties out of NBC Universal. But Comcast's cable business has won it the quote-unquote Worst Company in the World award multiple times and has been in the top 5 of that list many years running. They are effectively a monopoly in many of the places they serve, and many people don't take too well to lack of choice for what they think of as essential services. Now that we know a bit about the companies, let's start digging into the numbers. Comcast and Disney are both billion-dollar companies, but I'll be honest and say that before I started, I would have assumed Disney had the bigger business. If you just compare Disney to NBC Universal, Disney is indeed larger. But it's Comcast's telecom business that puts it way over the top. Just that business alone rivals Disney's overall numbers, which is how it was able to buy NBC Universal and Sky in the first place. With those additions, Comcast isn't just competitive, it's the market leader. Sky alone made a nearly $20 billion addition to those numbers. Disney's direct-to-consumer business, listed here as DTCI, is something to watch. You can see how quickly it's growing, and that jump in 2019 is largely attributable to the launch of Disney Plus, which rolls up into DTCI. It'll be a while before it's made back the considerable investment Disney has made in it, but it's off to a great start. Speaking of growth, let's take a look at those numbers. This is another area that came as a bit of a surprise. Looking at Comcast, you can see some fairly steady, reliable growth. Not spectacular, but strong and, well, steady. Disney, on the other hand, has less reliable growth, but when it grows significantly. And by the way, that near 100% growth in equity in 2019 is not a mistake. Disney's shareholders' equity grew 98.5% between 2018 and 2019. I believe this was largely due to the Fox acquisition, as was the drop in net income attributable to the acquisition. What remains to be seen is what's going to happen next year. The coronavirus has shut down most of both companies' operations, and Disney has had a little help with Disney Plus, but much of its effort to create new content for the streaming service have also been hampered by the economic shutdown. Comcast has had similar struggles, but actually beat Disney to reopening its theme parks, and its cable communications business hasn't seen much of a decline. I think growth is likely to be off the table for both companies next year. To what degree is yet to be seen, and I'll talk about that a bit later, but for now, let's look at the short-term liquidity of both companies. Before I do that, I should note that we're doing so at a bit of a disadvantage. Comcast doesn't list inventories in its balance sheet, making it impossible to calculate some of the typical ratios we'd look at here, and skewing a few of the others. But for the ones we can directly to compare, with the exception of Comcast's significantly better AR turnover, both companies seem to be in roughly the same place with regards to their short-term liquidity. What's fairly shocking is the working capital, which is in the negative for both companies. Disney is in a slightly better position to the tune of $1.7 billion, but both companies seem to have a significant percentage of their current liabilities in accounts payable and current debt coming due. This could be due to a longer accounts payable policy, basically holding income as long as possible before paying it out. Let's take a closer look at the capital structure to try to make some sense of that. I really want to dig into these numbers and help make a little sense of how laden down these companies are. Despite both companies having a relatively small difference in current liabilities, Disney's make up nearly a third of its total liabilities, 32.6% if I'm being precise. Comcast, on the other hand, comes in at 18.3%. But as I alluded to on the previous slide, it's the accounts payable that make up the bulk of both companies' current liabilities, so I believe my inference that they have longer payback policies to be accurate. Comcast's total liabilities are significantly higher than Disney's by nearly $70 billion, comprised mainly of long-term obligations. I think it's fair to say that both companies are capital intensive. The equity for both companies are, again, nearly identical. If it weren't for Comcast's long-term debt, these companies would be looking much more similar in their structures. Now, this puts some interesting color into the working capital picture. Both are in the negative, but Disney seems to be somewhat better able to manage it in the moment. If and when Comcast's long-term debt rolls around, it could find itself in a cash crunch. But the bulk of that long-term debt was taken on in 2018, so that may be a while. That said, it's not uncommon for the market leader to be leveraged to get into that leadership position. Given Comcast's core business was telecommunications infrastructure, I can see where that required a massive capital outlay to build. The theme park business is also capital intensive. Disney is in the cruise ship business as well, which has 3 pending orders for new ships, all of which can cost between half to $750 million to build, growing to more than $1 billion once made ready to sail. So this all begs the question, what kind of a return are these companies getting on their capital? Well, I'm glad you asked. The companies are largely split, with Disney performing better on return on common equity and equity growth rate, while Comcast has a higher return on net operating assets and return on long-term debt and equity. That last one is interesting to me. Both companies are capital intensive, and I think that's an important measure of how well the firms are using that leverage to grow. Comcast is higher, but only by a fraction of a percent. Otherwise, the differences here are really the result of the difference in their capital structures. So what impact has this had on their operational effectiveness and profitability? Again, these companies are very similar in structure, but while Comcast has had a higher gross profit margin, Disney nets out more profit. Disney is well known for its operational effectiveness, and I think that's how it's able to achieve these results, even without a telecommunication business that is essentially a money printing machine. So the goal here is to pick a company to invest in, so we need to talk about the actual stock performance of both companies. Before I do that, it's worth pointing out that while in theory the performance of a company's stock should be tied to the fundamentals of the business, in practice this is rarely the case. You need look no further than the current market having nearly completely recovered while we're still in the midst of a global pandemic, many companies still shut down to some degree, and 40 plus million people still unemployed. Despite Comcast having a fundamentally stronger business, Disney appears to be valued more highly, with a market cap $30 billion more than Comcast. Disney's stock has grown 52.64% in the past 5 years. Comcast stock has grown 55.77% over the same time. The dividend yield for Comcast is a bit stronger as well, 1.87% versus 1.2% for Disney. I think it's fair to suggest that Comcast's higher dividend yield and a history of steady dividend growth has helped its market value against Disney. So why the disparity? If Comcast's business is stronger, why does Disney outpace them in the market? I alluded to this earlier when I mentioned that Disney is one of the most beloved brands in the world. Disney imprints itself on the young and grows with them until they have kids of their own. It wouldn't be a surprise that people would want to own part of a company that they admire. Comcast, on the other hand, doesn't enjoy that same level of admiration. I think it's reasonable to say that there is some aspect of goodwill in Disney's stock price. To put it another way, Disney stock carries a bit of a price premium compared to its financials. So what does the future hold for these companies? I'm going to present this forecast with the biggest caveat I can possibly slap on this. 2020 is not a normal year. Disney practically saw its entire business shut down due to COVID-19, but was able to furlough workers and possibly slash its costs. Comcast has had some business operations that are more resilient, but still saw major contractions. Regardless, it makes forecasting difficult because we just don't know how much the business will bounce back or how quickly. So that said, I chose to go ahead and forecast as if 2020 was a normal year. I used the compound annual growth rate calculated earlier to forecast the selected financial data of both companies. And while 2020 is going to vary significantly from these numbers, I think it's reasonable to assume that these may be a close approximation to what we may see for 2021. It all depends on the strength of the recovery. As a lifelong Disney fan, it pains me to say it, but if you're looking for a stock likely to maintain steady growth as part of a portfolio, Comcast is the one to choose. The lower cost to acquire the stock makes it an attractive buy compared to the price premium Disney carries, allowing you to pick up Comcast at nearly a 3-to-1 ratio compared to Disney. As we've seen across this analysis, both companies have strong businesses when it comes to the fundamentals, but Comcast has an edge in quite a few areas. One key business is telecom, which is an area outside of Disney's core competencies, and one that gives Comcast virtual monopoly power in its service areas due to the franchise agreements in place. Even with the trend toward cord cutting, where customers are foregoing cable TV in favor of streaming, Comcast still retains them as customers because of its internet offerings. This business is remarkably stable and helps offset the riskier areas in the business. Moreover, Comcast is now even more vertically integrated than Disney, owning the content you want to watch, the networks you want to watch it through, and the pipe that brings it all into your home. Ultimately, the deciding factor for me was that telecom business, and one pretty major issue, that being COVID-19. The telecom business saw an increase in demand this year, partially offsetting the contractions elsewhere. And while Disney took a massive hit, at one point suggesting they were going to see a 90% reduction in business, Comcast was able to smooth that out somewhat. That said, while the fundamentals of Disney's business aren't quite as sound, they are still a behemoth in the industry, and while their growth is more uneven, when they grow, it's big. Their stock carries a premium, but that also makes them a bit more resilient when it comes to downturns in the business. As far as I'm concerned, you can't go wrong with either, but Comcast does have an edge overall.